All right, we're quickly going to look at what we call tax expenditures, which this is also a part of paying taxes. This is activities that the government lets you deduct from your income. So the government can encourage specific behaviors by making them things that reduce the tax burden that you have for the country. So, for an example here, we see a woman making a donation to charity, and that's one of the behaviors that the government wants to encourage. So, if you donate to charity, you don't end up paying income tax on that money. So, on the government side of things, we call these things tax expenditures because basically the government is losing money every time it lets someone deduct these activities from their income. So these end up costing the government a lot of potential tax revenue, but the government uses these to motivate a specific behavior. So to people, we treat these as tax breaks or tax deductions. Now, the activities that they go for tend to mostly benefit wealthier taxpayers, tend to help people with more money reduce their tax burden, because poorer taxpayers are not really going to be very likely to have a lot of extra money to spend on these things. There's also a feature of taxes called the standard deduction, which is a pretty large number. It's about it's $12,000 for a married couple, and if you are not like donating or otherwise investing that much money, then it doesn't impact you in any way. So this is only for people who are able to reduce their tax burden by more than $13,000. So one of the big things is that people don't have to count money that they paid for healthcare as part of their taxable income. So like you can save up all of your bills that you've had to pay for doctor over the course of the year and potentially subtract that from your income that you're paying. You don't have to pay taxes on money that comes out of like retirement funds, like 401k plan or something like that. In states where you have already paid tax, you can reduce that amount of money from your tax burden to the United States government. So you can take away all of the money that you've paid to the state of Tennessee over the year and subtract that from your income. If you have interest on big loans like mortgages or student loans, you're able to take that money off of your income as well. And the big one is money that people like donate to charity. So that's something that like everyone can do and can access. This is how the government encourages you to do a behavior that they want. They want you to help charity. They want you to buy homes, go to college. So this helps you, but doesn't necessarily impact everyone across the tax code fairly. All right, so on the government side of things, tax expenditures contribute to the budget deficit because this is a lot of money that the government is not collecting in taxes that it otherwise could. In 2016, that was $1.5 trillion that the government did not collect because it let these people deduct this from their income. Remember, the budget deficit in last year was $3 trillion. And so these are things that, may not, these are things that may change in the future because they don't benefit everyone the same way. Some people think these are great. Other people think these are what contributes to the deficit. But you'll see that more than half of all of these benefits go to the wealthiest 20% of Americans. So a lot of people, a lot of like most taxpayers aren't getting the amount of benefits that the richest taxpayers are. But we have a lot of interest groups out there that want to make sure that these tax benefits stay in place. Like every charity wants to make sure that these tax breaks stay in place. Real estate groups who try to get people to encourage people to purchase homes instead of rent. But you can see a list over there on the left. So it's a lot of stuff like you could get a credit for children. You can get money that you've paid to your mortgage interest. Things that you have purchased, like for healthcare, for charitable contributions, and things like that. So this is all money that people don't have to pay taxes on, but it means that it costs the government a significant amount of money. All right, it's time to talk about tax structures. And I really wish we could spend days and days and days doing this. I really genuinely do. This is one of the most important things I think we can learn, but it's just not really on our AP test a whole lot. But we want to make sure that we can understand the differences in how taxes are charged so that we can better understand the arguments about taxes in the country. So we see a couple of maps here, which we'll talk about in a minute, but we see like, income tax rates by state, and we see sales tax rates by state. So let's talk about what's different about those types of taxes. All right, so first up, we have what we call progressive taxes. This is what the income tax is. So people with higher incomes pay higher rates, like they pay a higher percentage. The percentage that you have to pay into taxes goes up as your income goes up. So at the beginning, if like we had said earlier that anyone who makes less than $10,000 a year does not pay taxes. So actually, no American pays taxes on their first $10,000. But marginal rates apply to any amount of income earned past the lower rates. So you would pay a small percentage of income on like your 10,000 and first dollar. The highest marginal rates, so the highest tax rates we've ever had in the 1950s and 60s were 94%. And that was for the very highest end of income. So people were not paying 94% of all the money they made. They were paying like 94% beyond $1 million of income. So they still had like plenty of money to meet all their needs and everything like that. But the government was able to raise a lot of revenue that way. In a progressive tax structure, the rich bear the burden of funding the government. The rich are paying more, not just because they make more, but they're paying much higher rates than poorer Americans are. The rich are not hurting. They're still able to definitely go way beyond meeting all their basic needs. They still have way more money than everyone else. But they are paying a lot of their money to the government, and the government is then able to provide better services for all people. The very high marginal rate, so now that highest number is 37%, but when that number was much higher, that forces companies to find other forms of compensation. So like companies would have to do other things to make themselves attractive to the best employees. Progressive taxation has a big role in the redistribution of wealth. We can look over time and we can see that when the taxes were the highest, the gap between the richest and poorest Americans was the smallest. And since the taxes have been reduced consistently since the 1950s, the gap between the richest and poorest Americans has grown and been accelerating over the years. So an example of a progressive income tax, or example of a progressive tax, is the income tax. So for example, like I am about in the middle of the incomes in the United States, and so I end up paying about 20% of my money in taxes. Each of you guys is the poorest of Americans, and I'm treating you like individual taxpayers here. You guys don't have a lot of time to work. You work part-time jobs after school and on the weekends. So probably none of you guys are making $12,000 a year. And so you are paying 0% in taxes. That's the way that the government shows you need all of your money to meet your basic needs every day. I need most of my money to meet my basic needs, but I'm still paying 20% of my money into the government. And then we'll take my friend Ja Morant, who's making millions of dollars, and on the highest end of his income, he's paying almost 40% into taxes. So as the incomes rise, the percentage of taxes rise. We also have proportional taxes. So proportional taxes charge the exact same rate to all taxpayers. This is going to be a little confusing when we get to the next one, but we're just talking about the same percentage to all taxpayers. And that means that rich people will still pay more money because they will earn more money, but they'll pay at the same rate as poorer taxpayers. So the poorer people will still be subject to these taxes, even though they might not be subject to progressive taxes. So every single American pays Social Security tax. Every single American is charged 6%. So you are paying 6% of your money into Social Security. I am paying 6% of my money into Social Security, although that is a much larger amount than what you are putting in. And then our friend John Moran is paying a lot more money into Social Security, but still just 6% of his income. Um, a similar tax would be, we see houses there. This would be a property tax. This is what a lot of states do. So they charge a percent of the value of your home, and then we all pay the same percentage. And so, like, wealthy people who live in very nice homes pay more money, but they're just paying a percentage of the value of their home. People who are living in like smaller, less expensive homes pay the same percentage of that value, but it's a much smaller number. So a proportional tax means we all pay the same percent. All right, let's talk about regressive taxes. These taxes are easy to convince the public to support because people don't really understand how they work. But these taxes actually take a higher percentage of income from the poor. They don't charge a higher rate to poor people, but they take a higher percentage of their money. So this is what happens when all people are charged the same dollar amount. So this is like, it's easy to advocate, like it's easy to argue that all people should just pay the same amount in taxes. That's fair, but that is a much higher percentage of poor people's income. So taxing people the same dollar amount takes a much higher percentage of a poorer person's income than it does from a richer person. So I like to think of this in terms of how long it takes a person to work. So an example of a regressive tax is the sales tax. We all pay the same amount of money into a sales tax. So let's think about something that you and me and John Morant all do. And we all eat. And we all eat a lot. And like, he doesn't eat more than us because he makes more money than us, right? So, everybody's going to buy like groceries. So let's say you and me and John Morant, we all have to spend $100 on groceries. Well, in Tennessee, the sales tax is 9.75%. So let's think about like, if we all buy $100 worth of groceries, we're all going to have to pay $9.75. So how long did it take you to earn $9.75? It probably took you an hour, right? Or something like that. Maybe you guys have great jobs out there. I sure hope so. But it probably took you guys about an hour or maybe more than an hour to earn $9.75 just to be able to pay the tax to purchase your other groceries, right? So when I go to pay that tax, I make several $1,000s a year. I make about $300 a day. So for me to make that $9.75, it takes me about 20 minutes, I think, to pay that tax to buy the groceries. So for you guys, it took an hour to earn that money to buy the groceries. For me, it took way less than an hour to pay that tax, maybe 20 minutes. And for John Morant, who's making, I think this year about $8 million a year, it's taking him minutes, if that, right? It's taking him a very small amount of time. So this is a much larger percentage of your income. Now, the national government is running on a progressive tax system. It gets most of its money from that income tax, but state governments are more likely to run on these regressive tax systems. So at the state level, we have a lot of people who just get out there and argue like everyone pays the same amount. That's the most fair way to tax. And so this is what like a consumption tax is, like a sales tax, a excise tax. These are regressive taxes, but because rich people don't pay the same, like they don't end up paying the same percent of their income. Like it is like rich people may eat nicer food, but they're not like eating way more food than all of the rest of us. They're not consuming way more gasoline than the rest of us. So when people pass sales tax or what we call a consumption tax, that disproportionately puts the tax burden on the poor. And we talked about Social Security tax, but this also, we'll get into those details later. It's actually also a regressive tax because rich people don't actually have to pay the same percentage as the rest of us. So beyond $118,000 a year, you don't have to pay any more Social Security tax. So I'm paying way more Social Security tax, and you are paying way more Social Security tax as a percent of your income than a rich person like our friend John Morant. All right, real quick, so we can help you pick out a place to live in the future. Let's look at some different tax rates state by state here. So, this is the income tax. So, income tax rates are going to be progressive. This is what liberals advocate for. Liberals want income tax based states because they're progressive, because they tax rich people at higher rates to provide services for people that need it. So you'll see here Washington, Nevada, Wyoming, South Dakota, Texas, Florida, Tennessee, Alaska, and Texas. Tennessee, actually, this is about dividends and stuff, so it doesn't really matter. But these are states that do not have an income tax. So those states charge 0% in income tax. We'll look at some other maps in a minute here, but you'll see these income tax rates across the states. We have higher tax rates in liberal states like California, Oregon, New York, New Jersey. We have lower income tax rates in conservative states, and that's not a pattern across the board. You see a very low income tax in Pennsylvania. Um, but we have these are our state income tax rates, and we have quite a few states that choose not to charge an income tax at all. Then we've got property taxes. Property taxes, this is a tax charged on the value of your home or the real estate that you own. And we have some high ones here. We have Jersey and Illinois as the highest. The lowest down there, like Alabama, Hawaii is the lowest of all. But these are more of a proportional tax. So it's a rate that's the same for all real estate, but wealthier people will have like more valuable real estate than poorer people will have. So you'll see Tennessee does have a property tax here, and so that is one way that Tennessee raises its money, but it is not even one of the highest property taxes in the country, despite having no income tax. So this brings us to our last one, our sales tax rates. Remember, this is a regressive tax structure because this charges more of a percentage of poor people's income than it does of rich people's income. And there we are, Tennessee, number one in the nation, at a 9 point. That's because we do charge different rates for groceries and other stuff. So it averages to 9.53% on every sale. So Tennessee has the highest sales tax in the nation, and that's how they make most of their revenue. And you will remember that the regressive tax puts the burden of funding the government on the poorer Americans. So in Tennessee, you see a lot of these states around the South: Tennessee, Louisiana, Arkansas, Alabama. That's our top four. Washington was another one of those states that did not have an income tax, so it has a very high sales tax as well. But these are states where the burden of funding the government is spread out among all consumers at more equal rates, so it is a much higher percentage of poor people's money. Now, this is what conservatives advocate for, because the argument is that sales taxes are fair because everyone ends up paying the same amount. So when we're thinking about tax policy in this country, we want to remember that liberals want progressive, like income tax, and conservatives want a like more like flat tax, like a sales tax. Speaking of taxes, there's a guy who hates paying taxes. Here's our friend President Trump, who worked so hard to keep his tax records a secret so that we would, as American people, would not find out how much taxes he avoids paying, despite becoming very, very wealthy off of the great state of New York and its people. So what we want to make sure we can do today, we've got to make sure we can discuss the main sources of government revenue: the income tax, the payroll taxes, the corporate income tax. We want to make sure that we can describe the different types of taxes. So talking about like, what is an excise tax? What's the estate tax? What is an income tax? What is a payroll tax? We've got to be able to explain the different types of tax structures. So, like, explain how the progressive tax structure works, explain how the regressive tax structure works, and we need to be able to describe examples of those too. So, remember, income tax is progressive, that's the one that liberals will advocate for. Sales tax is regressive, that's the one that conservatives will advocate for. So, that's basically what we need to make sure we can understand about the government's revenue. All right, now that we've dealt with the revenue of the national government, we will now move forward and find out where the government spends all of its money. So we will take a look at the expenditures of the government.